let's get started. As always, this is a community, so a reminder to review the guidelines, and we'll be reviewing and removing anybody if they breach these guidelines. Please flag to us if you've had any incidences, but otherwise hope to keep things friendly. And just a reminder to review the guidelines. Our Radical AI Founders Compute Cohort is open. So just a reminder in case you're new to the community and haven't heard about this yet, this is a separate program. So you have to apply through the application link that's available in the Slack, also available to you in the emails that have been sent out. This is your opportunity to access $250,000 worth of Google Cloud credits. You'll also get a year of programming, access to Radical Ventures folks, as well as the Google Cloud team. This will be a lot of hands-on guidance, as well as some full stack tools pieces. So there's a lot that comes with this program. It will be competitive, but we do highly encourage you to apply. If you're uncertain, message me, but I think it's worth putting in an application, even if you're not entirely sure where your product is at today. If you're going to be using compute, if you're going to need a lot of compute, really recommend that you put your application into this program. A lot of you have reached out to me already. Just a reminder that we have moved the dates. So the applications are no longer due on the 25th here anymore. They're actually due on the 31st. So we're going to be moving this down a little bit just to give folks some more time. Also, you'll be able to attend next week. So I don't have the slide here, but next week we're going to be able to share the go-to-market piece. So part of the application is the go-to-market function, your business model. So that will be part of it. And so you can use next Thursday's session to get some of those questions answered. A reminder, we're going to have Sean from Weights and Biases joining us, as well as Parisville, who's a partner at Radical Ventures. So we're really fortunate to be able to have them join us and answer a lot of your questions about turning your product into a business and what that go-to-market and sales motion can really look like from experts who've done it before. So really excited for that. But I won't take up any more time. We only have the hour. So I'm excited that we're joined by Daniel Mulet, who's a partner here. But before we get into Q&A with him and with the broader team, we also have Blair Bernholtz, who is our CFO at Radical Ventures, as well as Katelyn Elder, who's a Senior Director of Finance at Radical, and Erica, who is also joining us at Radical on the finance team. So these folks, we're very fortunate to have them answer our questions today. They work with all of Radical's portfolio companies and really know about operational foundations and building the backbone of your company. So going to hand it over to them now to kick us off. And welcome, Blair. Welcome, Katelyn.
Go to the next slide. Hi, everyone. Thank you so much for joining us today. So Radical Finance has put together just a few very short slides, and we're mostly just going to talk to the bullets on these slides. And really the focus of the conversation today is kind of these straight out of the gate finance back office related items new companies should be thinking about. So on the slide that's up right now, you can see 4 items. And the pillars presented here are the first focus areas we generally speak to companies about right after incorporation. And as I said, this is going to be the focus of today's conversation. In addition to these like straight out of the gate pillars, a founder should also consider a news company's back office infrastructure, which at a very high level includes your IT solutions and how these scale as your company grows. 2, the HR function, where Radical's talent team, which I think you've already spoken with or will be speaking with, can talk about, as well as corporate compliance and governance, which include how a company's board of directors functions, company policies, and how a company will operate within the regulatory framework it's subject to. So diving right into the finance pillars, the first of the finance pillars we have up here is budget and cash management. So step 1 in a company's cash management journey is picking your banking partner and opening a bank account. There are many tier 1 banks that have specific groups that focus on the startup community and generally offer benefits to this segment of the market in terms of bank fees and ancillary products. And ancillary products can include, corporate credit cards, a hands-on relationship partner, or access to venture debt. It's important to highlight that given a bank's internal regulatory process, opening a new bank account for a new company could take as long as 6 weeks. And someone trying to open a new bank account for a new company should be prepared to fill out a bunch of documents for this opening process. This is not shady business in the back. This is, generally just what can be expected for any bank to get comfortable and work through their know your client, or what is also referred to as KYC process. The most basic concept in cash management is also the most critical. And this is understanding how your company will achieve the milestones it has set out to achieve with, its initial round of funding that was just raised. And a starting point for this is a company's budget and forecast, which is used to determine what cash is needed on a month-by-month basis in order to achieve a scaling company's hiring strategy, research and development initiatives, and in most cases cover the cost of compute amongst other more general operating items, such as like your rent, your utilities, and anything that kind of keeps the lights on and employees paid. To ensure that a pre-revenue company has sufficient cash runway to meet these expected costs, having a detailed understanding of a company's cash needs and a supporting cash management policy really is necessary. A cash management policy would generally focus on a company's cash needs in the short term, so defined as maybe that 3 to 6 month time frame versus the midterm, which is viewed as a 6 to 12 month time frame, and then into the longer term, which is any cash needs greater than 12 months. Distinguishing the timing of cash needs allows a new company to invest cash, which is not immediately needed for operating activities, to invest this in the short term. That provides, and in doing so provides added protection for the cash on hand, and potentially there might be some upside in terms of some additional interest or yield that might be earned. I've said a lot in terms of budget and cash management. Is it okay for me to open up to questions specifically on this now, or should I dive right into payroll and benefits?
Just see, no one's put anything in the chat. Does anybody have any questions on this now? You can raise your hand or just unmute yourself. Okay, I think you can keep going, Blair.
Perfect, payroll and benefits. So all employees, including founders, need to be paid. And this involves more than just cash into an employee's bank account. A company is also responsible for ensuring that appropriate payroll taxes are remitted to the right tax authorities on behalf of a company and on behalf of employees. And a company does not want to get tax remittances in this regard incorrect. It is important to remember that if you have a dispersed workforce, for example, employees in multiple countries or in multiple jurisdictions, same country, but different provinces or states within the same country, different payroll registrations and remittances will likely be required within each jurisdiction your company operates in. And that would be each jurisdiction you have an employee in. We would generally recommend onboarding a payroll processing company for payroll setup, ongoing payroll processing, and the preparation of the various tax forms and filings that are needed for the company and the employee. So this would be annually, you have to give all your employees. In Canada, it would be a T4, it would be a W-2 in the US. And then moving on from just general payroll setup, there's also employee benefits. And on the benefits, again, we would generally see new companies engage a benefit broker. Benefits offered to employees can be part of what makes a company competitive when hiring talent. And a benefit broker can provide valuable insights into what is market for comparable early stage companies. Various payroll processing companies, so those companies we had mentioned, you'd want to engage in to get your payroll set up and processed, also offer benefit solutions. So just like remitting payroll, it is important to understand the employee benefits may need to differ across different jurisdictions, countries, provinces, states. and market comparables might be different across different jurisdictions. It's also more generally important to understand, am I offering benefits in a jurisdiction that has public healthcare or private healthcare, and that impacts, going back to, budgeting and cash management, what expected costs of providing benefits to your employees might be. That's benefits, that's pillar number 2, payroll and benefits. So again, Leah, any hands up, or should I continue on to bookkeeping and accounting?
There are some questions here. Sarah, do you want to ask your question directly, or do you want me to? Sarah comes online here. I'll see. No. Okay. So Sarah's asked, is there?
No, it's okay. You can ask it. Thanks.
Okay, great. Asking if there's one of our portfolio companies and or leading edge AI companies that we would recommend in financial operations. If I know we work with many vendors as well. We can also provide some resources after. If you have any thoughts on that area of financial operation support.
Yeah, perfect. So I think that kind of is a good segue into item number 3 with this bookkeeping and accounting, and generally what we would recommend for a new company. Leah, that's correct. There are a lot of vendors out there that offer a gamut of kind of advisory, bookkeeping, accounting, back office, initial setup to early stage companies. And we do have a list of certain of those companies that our portfolio companies work with. Perfect.
One more question before we just roll into that. We have Maitesh asking, I'll just ask you just for time-wise right now, talking about the fact that founders need to be paid. He's just that to make more progress on the product, considering it would make sense to skip paying the founders until there's a product market fit. How do we think about paying founders or self-paying? How have you counseled some of our founders to think about their own self-pay?
Yeah, so I do think I think it's probably a unique and different across different companies, and generally this would be something at the board level that would be discussed and decided upon. And I, generally, there is, and maybe it's a matter of what level of compensation that compensation is, and the form of that compensation needs to be considered, not just in, base salary and potential bonus, but, option grants and the whole gamut of how all of those things interact. And that is something generally, especially in terms of the component that is options, that would be discussed at the term sheet stage.
Got it. And we're also joined by Daniel here, who's partner at Radical Ventures. He sits on some of our boards. He's also worked and directed at some of the global accelerators. Daniel, on this, do you have any thoughts around kind of motivation and pay or other additions here to add to Blair's point?
I mean, there's the legal and kind of tax compliance side of, you are an employee of the company, and so there are terms related to your employment. So, generally you would like to have some level of compensation there, and as Blair mentioned, that's usually set as part of the board and governance and all of these things. Now, the reality is, a lot of it depends on the constraints within which you're operating. If you're a solo founder just getting started, where you're doing a bit more of market discovery and ideation, and you haven't raised any funding, that might basically give you a budget that you can work with, which is negligible. So I understand the rationale for wanting to dedicate all the resources towards building the products, shipping, and getting the company as advanced as possible. What I've seen over the years is, depending on people's financial situation, if you don't have commitments, if you don't have a mortgage or a family, or if you have other income sources, you may not require as much as in terms of a personal burn rate, so to speak. So sometimes I've seen founders not pay themselves for the first couple of years. In some cases, they start, especially university spinouts where it's younger people that are just leaving their master's or PhD programs, start off with a salary that's well below market rate and invest all their resources in the rest of the company and being able to help and hire other people on the team. And over time, those salaries will increase and become more market as you prove out that there's a business, that there's a there for what you're building. It swings wildly. On the one hand, you could be an applied ML engineer at a FANG company making a lot of money, and all of a sudden you don't have any in a company. So it really can create a bit of a sticker shock. So I guess the short answer is it really depends. Generally, founders will underpay themselves and dedicate more of their resources towards hiring a team that give them more leverage towards moving faster.
Great. Thank you, Daniel. And thank you in the chat as well. All right, Blair, do you want to roll into pillar 3?
Yeah, perfect. So pillar 3 is your bookkeeping and accounting. How a company maintains its books and accounting forms the basis of being able to deliver financial reporting, tax reporting, and effective budgets and forecasts. So going back to item number 1 here, bookkeeping should really not be viewed as something so simple at the beginning that it's sufficient to track numbers in an Excel workbook only. At the onset, a company should onboard a cloud-based accounting tool. And this is like QuickBooks Online, Xero, like there's a ton with like FreshBooks, there's like a ton of cheap and cheerful solutions on the market. And this cloud-based accounting tool enables the company to track inflows and outflows, set up vendors, and produce valuable financial reports right out of the box. On risk mitigation, an accounting tool will also have embedded financial controls and will enable a company to have a single source of truth for their financial records at the onset, which, could really save time as companies go and maybe raise even their first round of funding, subsequent round of fundings, less kind of cleanup from the beginning needing to be done. Thinking about the initial setup of a company's books and records, the ongoing time needed to maintain accurate books and records, and accounting for every company transaction could seem like a daunting task that will likely distract a founder from the core business operations. So given this, we would generally see, and we would recommend that a new company outsource this function from the onset. And that goes back to the earlier question that was asked. There are a ton of vendors out there providing accounting and bookkeeping services with a focus on the early stage market with expertise in what a company needs at like the very first stages of its life cycle. And then that goes beyond. The right partner will provide services that go beyond just like booking an entry in a system. And it would cover things like, setting up payroll, also connecting, depending on what your payroll provider is, figuring out how benefits fall into there, and integrating kind of where you're banking to the software that you're using. So it really helps operate very seamlessly and efficiently. Any questions on that before I move on to the last pillar of tax compliance?
I don't think so. We're seeing, there's none in the chat. Anybody? No hands up? Okay, continue.
Perfect. So in a similar thread to everything we've been discussing, this last pillar that we focus on is tax compliance. And like, as you guys can see, I'm reading on a piece of paper and I have a little joke typed here, but I've realized it's so corny, so I'm not even going to say it.
No, you have to.
Right?
Please say it.
So, okay, fine. I recently heard a quote that today it takes more brains and effort to make out the income tax form than it does to make the income. Right? I don't know if other people feel that pain or not, but it does hold true even for companies at a very early stage operating at a loss and not even needing to make any income tax payments. Every company is subject to tax, and this goes beyond corporate income tax. at a minimum, a company needs to consider whether they're making payments or not, filings as it relates to federal and state or provincial taxes, sales taxes, payroll taxes, and all of these different areas of tax, depending on the operations of a company, may require a monthly filing, a quarterly filing, or annual filings. In addition, in every jurisdiction may have different tax incentives available to new companies, specifically companies focused on research and development. And like, as an example, in Canada, there's a SHRED program. So that's, you know, incentives for companies doing scientific research and experimental development. And a similar tax credit program in the US is the research and experimentation tax credit program. So, you know, yes, there's compliance obligations, but there is benefit to actually having an understanding of the tax environment you're operating in and what incentives are available, because there are a lot for new companies. So, you know, just given potential volume and the specific tax knowledge required to, even at the base level, prepare and remit various tax forms, and on this broader scale, position a company to maximize any tax benefits available to them and reduce potential future tax liabilities when you do have a revenue stream. We do, again, often recommend that from the onset, a new company outsource this work. And again, going back to number 3, there are a lot of vendors out there that, in the gamut of services, as you're kind of outsourcing and working with an offsite or an outsourced team on your books and records, they will have, the right partner could also have expertise in tax items as well. So I think that is everything on the, you know, initial finance pillars that we would generally recommend a new company focus on. And with that, I can pass it on to Katelyn to talk about some key takeaways to consider when you are building your back office.
Thanks, Blair. So I know you touched on a whole bunch of different things that you need to think about when you're setting up your back office and thinking through kind of your finance function. So here we just tried to distill it into 5 key things to remember when you're working through that process. And the first thing is, know what you don't know. Like, it is totally okay to not be an expert in tax and not be an expert in accounting and payroll and tax compliance and all these things. And it is okay to use like external experts and service providers to help with some of these like more complex items. And in some cases, I would say in most cases, it's actually preferable because it lets you focus on your business, which is what you know best. And it also makes sure that you don't run into issues down the road with like bigger mistakes by relying on people who actually know what they're doing. And there's also a whole bunch of service providers out there that are specifically focused on the early stage market, and they're priced accordingly. So it doesn't necessarily mean you need to break the bank if you are engaging some of these like outsourced functions. And Blair touched on a bunch of them, but like examples of things you can outsource are finance and bookkeeping, as well as other fractional finance services at kind of more senior levels, payroll processing, tax compliance, tax advisory are all examples of things you might want to consider outsourcing. So the next point here is be thoughtful about your tech stack. And I know we kind of have touched on this as well, but there are a lot of really great tools in the market that can help in a whole bunch of different aspects of the back office and finance functions, such as payment processing and expense reimbursement, like payroll processing, vendor management, like all of these different aspects. And a lot of them also integrate really well with various accounting platforms such as QuickBooks Online or directly with your banking platform. So like the more your tech stack is integrated, ultimately the smoother it will run, the less manual intervention you need to make, and like ultimately just the cleaner it will be for the, like, doing less work. So even if you aren't implementing your entire tech stack on day one, just kind of thinking about what is out there, what you might eventually want your tech stack to look like, and understanding how those things integrate with the accounting platform you're using is a worthwhile exercise, and it will just save you time down the road. Okay, so the third one is your finances are important and review regularly. So I don't think you can overstate this one, that like your finances are extremely important. Even if you have outsourced the day-to-day bookkeeping, which we do recommend that you do, you have to understand that like your books and records are only going to be as good as the information you're giving to your outsourced bookkeeper. And so having regular check-ins with them so that you're communicating what's going on in the business, you're making sure they have all the information they need to get the entries into the system and get your financials in, like, to be accurate is really important. And that can be as simple as having a 10-minute call at the beginning of every week just to talk through the activity. And we recommend that you do a thorough review of the financial statement package monthly. So that would be like reviewing the balance sheet and income statement for things like, does your cash reconcile to the bank? Like, are there, like, do the expenses, are they in line with what you expected? Are there any that seem too high or too low? Like, are there any liabilities that are missing? Because you, again, know your business the best, so you will be able to identify if there are any issues. And the more accurate your financials are, the better business decisions you can make. So if you're thinking about a hiring plan, or if you're thinking about any like large upcoming capital expenditures, like having your financials be in good shape and be accurate will help you make better business decisions down the road. Leah, we can flip to the next slide. Okay, so the fourth one, and Blair kind of touched on this, is the importance of developing a cash management strategy. And in line with that, managing your cash prudently. It's like the most important thing is preservation of capital. Like, you don't want to go, if you get a funding round in, you don't want to go invest it in the stock market or whatever else. Like, the most important thing is you are preserving that capital to spend on building your business. So having a really good understanding of your cash burn, your anticipated cash burn, and your months of runway is extremely important. Like, your cash is extremely important, and knowing where you kind of stand on those three things will help you make business decisions. So using your financials and building out a cash forecast and understanding what your short, medium, and long-term cash needs are will help you kind of manage your cash accordingly. And like your short-term cash needs, your cash should be like very accessible in something like an operating account or business checking account. And your medium and long-term cash, you may want to consider some other options such as a savings account or term deposits or GICs. And often the best person to talk to as a starting point when you're kind of thinking about some of these other options for your cash is your main banking contact. Because likely there are products at your bank that may be a good fit. And if you don't find that, you can always go from there. But I think often simple is better, and remembering that even if you are trying to get a little bit of additional yield, it needs to be on products that are like safe, secure, like where you aren't going to risk losing any of the capital. Okay, and the last item is implement internal controls from day one. So internal controls are really important, and as your business grows, the types of internal controls may need to evolve as your team size grows, but often these can be really, they are basic, and often they're built into some of your existing like IT products, such as like IT access controls such as folder permissioning. Like you don't want every single person in your company to have access to your payroll and HR folders. There should be like access controls in place where those are truly limited to the people that need access to those types of folders and information. Another thing is on the banking platform, like your banking access should be fairly limited, I would say, to the founder and to whatever finance function you're using. And you can also distinguish between like read-only access and write access. So on your banking platform, you may want your outsourced bookkeeper to have read-only access so they can be recording the transactions, but it may only be a founder who has the ability to actually release and make payments. And I would say best practice, if ideally there are 2 people that need to actually approve to release a payment, if that's feasible based on the size of your company. So I think those are the main ones. And again, like as your team grows, you may need to kind of adjust and think about, but having a view to internal controls from the very beginning just makes sure that you're setting yourself up to like grow well and be able to kind of adapt as your team grows. So that's all of them.
Okay, perfect. So we have time now for some Q&A. So can be on these topics, general operational foundation. Some people have put a few things in the chat, but we've addressed a few of them. But if anybody has other questions, you can continue to put them in the chat, or if you want to put up your hand. For now, we can address the second one from Mitesh. If you want to speak as well, you can. I see that you're here.
Yeah, sure. Yeah. Thanks everyone for the insights. Very helpful. As far as my question was that as of now, like we have raised a pre-seed and we have a CEO and a CTO, and we manage all these operations between both of us. But like based on your experience, when do you see like a full-time person coming in as a CFO or a CEO or a dedicated person in this entire fundraising cycle to manage and look after all this? Like what's the best practice? Thanks.
Yeah, so I think, Daniel, I saw you put some items in the chat. Do you want me to start off or do you want to start off?
Go ahead, Blair.
Perfect. So I think, generally what we see is definitely not even at the Series A stage. Most often we see companies starting to think about hiring internally, probably like a VP finance or like a senior controller level, either, out of the gate of a Series B or maybe a little bit prior to a Series B as they're gearing up for a Series B is most often when we see companies starting to bring this internal. Also, it actually matters when this is needed internally based on when you have revenue coming in and what that looks like. So a company could be seed Series A, but they are generating revenue internally. They're managing a bunch of customers, and there are added complexities once that starts. And kind of FP&A, so financial planning and analysis, needs to look a little bit different once those things come into play. So we would potentially see companies bringing someone internal a little earlier on, but that role when they bring it internally generally may not be 100% like dedicated finance body as you may see in like a controller or something like that. It might be more of like a biz ops person. And that biz ops person, there's some kind of, biz ops folk that comes in and they kind of still oversee and the finance function and take more ownership and spend more time on that, on revenue forecast, kind of FP&A activity. And then it would be that individual kind of a little bit later on that would be like instrumental in helping hire the first like dedicated finance person. And
Blair,
Daniel, is that?
one clarifying question. What is a controller? What
Yeah,
kind of
so
experience has a controller had?
Yeah, so I think it's kind of a mixed bag, but generally what you would see from a controller is someone who kind of runs and oversees, and maybe they're even the ones inputting, but like, it depends on how many years experience the person you hire has, if they're actually gonna do from like cradle to grave or not. But a controller would generally own all oversight of the books and records, tax also, and they would help deliver financial information to, if there is a biz ops person internally, if there is to the founders, to a biz ops person, to the board, like they would be responsible for all of that kind of as it relates to the numbers and finances of a company. They would be involved in that and oversee that.
Yeah, thanks a lot. Really appreciate it.
Problem.
Thank you.
My quick thoughts are often people will hire either a chief of staff or we call them general purpose smart people. Just like a go-getter that's going to take things off of your plate so that you can free up your time to work on the business, not in the business. And so maybe now, maybe later is the right time. The trick is finding a person that you can afford and who's willing to take that early stage risk and is often more incented towards equity and upside and less looking for a cash compensation package. Often the CFOs and COOs are quite expensive. Even VPs finance can, they can make fairly high salaries in corporations. So, finding a recent MBA grad or a commerce undergrad who's willing to take that risk and help you build the business. And you want people who can take ownership. And even though they're not co-founders, in the grand scheme of things, if you're wildly successful and you're running a 600-person team, effectively the first 10 to 40 people will be the founding team in a large way. So, optimizing for people who are willing to take a risk and help you build this with you is probably the most useful guidance I could provide.
Okay, and that makes sense. Yeah, thanks a lot.
Wonderful. Other questions? Samuel, do you want to ask your question? Or would you like me to do it on behalf? Okay. So on his behalf, if you're selling to enterprise, when do you bring a dedicated salesperson to your team? So we talked about this a little bit already, but thinking through incentivizing that team member as well, incentivizing salespeople as opposed to, and this can generalize, I think, to incentivizing early employees that aren't necessarily going to be able to take part in either equity or the earliest forms of being a founder, your first kind of non-founder hire.
Daniel, I think I'm throwing this one over to you.
There's definitely a right time. There's no, I can't give you a very precise answer here. The general framework that I like to use is founder-led sales are probably the thing to go through or go with until you have written down your own repeatable sales playbook where you understand what are people's objections, what is the messaging that's working well, until you understand a little bit of the conversion metrics in your funnel. And part of the reason that that's super important is that you want to be as founding team members who are doing the sales as close to your customers as possible, because often there's a lot of problem and solution discovery that happens through this. You might be in a conversation with the buyer and they say a thing that all of a sudden reshapes your product vision or some of the features that you need to build or the capabilities that you need. And if you are abstracted from that conversation or disintermediated by that conversation with a salesperson, you're not getting that feedback. And that's really the most important thing early on, is just being as embedded and close to your customers as possible. So I generally we start seeing outside sales or hired sales leaders starting to come in after a Series A, and that's generally once you're starting to expand beyond founder-led sales. There's now finding the right people to be your first sales leaders that's more art than science. It's very hard to find people who are very good at this and treat it as a science and a discipline, as opposed to just going in and trying to sell something. So I think there's a lot of materials and a lot of resources around how do you build sales teams, how do you incentivize them properly. Typically it's base plus commission on amount sold, but all salespeople are not created equally. And so I think the best advice I've received for this is to go and speak with heads of revenue, VP sales, people managing sales teams in companies that are roughly in the same industry as you are, but 2 or 3 stages ahead. So if you've just raised a seed round, go and talk to somebody, find somebody who's leading sales at a Series B company and just get their advice and feedback. And if you're at Series A, go for a Series C company. I think that gives you really tactical advice and tactical feedback on what to look for and how to maybe get some free advice and implement some of those tactics before you're quite ready to hire someone.
And then one thing just to add to what Daniel was saying is that if you're thinking about order of hiring, generally we would see a company bring in a sales team first before they even think about bringing in-house finance.
Awesome. Thanks, team. Karthik looks like next in line. Are you willing to come online and ask your question? Karthik has come on.
I did.
Yeah.
Yeah, my question to Daniel regarding the operations. So as an AI startup, we try to use a lot of diverse data sources. It could be from the open source. It has different kinds of licenses and so on. But these days, I tend to see that there are a lot of these legal issues, legal compliances regarding the data side. So when it comes to that, how do early stage startups would need to mitigate these risks and compliance with the legal operations?
Yeah, it's a great question. There's the DIY way of going about it, which obviously some people have to go down because they can't afford legal counsel to help them manage this. And then there's relying on outside legal counsel. Mm-hmm. So if you have raised capital and you have a law firm that's representing the company, usually they will be able to at least give you a playbook that you can start internalizing and operationalizing yourself. It's very hard for me to give very, very specific feedback here because there's so much context that
I'll narrow it down a little bit. So let's say I did a pre-seed round and I raised with Radical Ventures. As Radical Ventures is my venture partner, would they have any sort of support to the startup in terms of legal compliance?
Yeah, so typically so after raising capital, we would have a company law firm, and so they would put out they would have playbooks and frameworks that are really tuned to the specific type of company you're trying to build, the tech stack, the types of data sources. Yeah. And we could sit down and walk through maybe even just a checklist at the earliest stages of the things to start thinking about. So if you're working in the life sciences space and you are licensing or using open source data sets in genomics, I think you would just want to keep a record of what are the uses of that, or are these licensed? Is it the MIT license? What use do you have for these? Are there any? And where was the source of the data set? So I think there's a lot of questions that you could just be asking and keeping a record of for all the different tools and data sets that you're using. This ends up being useful at your next round, because often what will happen after you've signed a term sheet for a seed round or a Series A is part of the confirmatory diligence, so the diligence that happens between law firms as people are trying to understand all the governance of a company, is they'll actually go in and ask, what are the software packages that you use, and do you have the right licenses in place? What are the data sources that you've used? Do you have the right licenses for these things in place? So, I think maybe the most tactical advice would be to get a checklist on the things that come up in diligence at a Series A stage company or financing, and then start working on tracking those things as you're building your tech stack and exploring the software packages that you use.
Yeah, this is awesome. Thank you so much. I think I'll start doing logging from now onwards. Thank you.
It's much easier if you just keep an Excel sheet where you just track, like, here's all the things and what are the license agreements, than if you then have to scramble to get that in place in 24 hours because the lawyers are asking for it, because that's going to hold up some transaction. But also in the grand scheme of things, people are scraping YouTube and using it to train foundation models. And so I think there's also a practical element here where you don't want to spend all of your time doing that.
Yeah, I mean, the most important problem I am observing is even the open source data, the source of the data itself is from somewhere, which is not the open source license. So that's why the legal compliance is kind of tricky at that point. And I thought out of your experience, you might know. So yeah, that's it.
Yeah, no, and look, it comes up on mergers and acquisitions and future fundraisers. It's going to continue being an issue for a long time. So I think for now, just tracking what you're using and being a bit conscientious on, if you have the option to use something where you can get full commercial rights, playing it safe there is probably a good place to start.
Thank you.
But full disclosure, I'm not a lawyer, and please seek legal counsel on anything specific.
Yeah, sure.
Perfect. Thank you. Amit, I believe you have a question.
Yeah, thanks. Guys, by the way, guys, this is an excellent session. And so my question is, at the inception stage, as you're putting together the budget, I just feel like the biggest approximation is actually in the areas that you just highlighted, because like it's so easy to kind of, have like how many engineers you need and, and the infrastructure and things like that. So during that stage, like, can we work with you to identify who would you be your preferred kind of, service providers, or so that we can actually model them more accurately, kind of a thing? Or it could be a part of process when we are talking to you around fundraising. You might say, hey, you actually should be kind of, have allocated a little bit more, or maybe you have allocated too much, kind of a thing. So do we have that flexibility? So my question is, as I'm putting together that spreadsheet now, I think the G&A is like the biggest approximation. So can we access some of those kind of rates or things like that, or costs early on in the process with you as we are doing that?
So Daniel,
for example, how much would it cost to have a bookkeeper, for example, on a quarterly basis, or some, like, so for example, even like the payroll. So rather than, like, you could probably outsource that to, in a SaaS company, right? The things like that. Would we be able to get like a list of who your service providers are, for example, do you like to work with, and how much do they charge, so that we can more accurately model our budget? That's the question.
Yeah, so you can start and I can add on if you want, or other way around.
You go ahead, Blair. You're the one who has all these great relationships with all the third parties.
Yeah, so generally the time frame where we, like, where Katelyn or I or Erica would step in with a portfolio company is post-closing of an investment. We do like a separate set of finance due diligence where we ask just general questions and assess, where we might be able to provide support and make recommendations and introductions. That being said, more generally, and Leah, keep me honest here, like, have we generally provided any kind of resource where we would say, hey, yeah, like, we know that this vendor is good in this space?
No, not typically. Like, I think last year, I can dig up and reshare from last year's cohort some of the resources that we did put together for folks that had more generalized recommendations. So we can share that list again.
I'd be happy to book like 20 minutes if you want to walk through assumptions. Like, we can fairly quickly give you
perfect
sense of
that's exactly right. Yeah,
it's really dependent on what you need, as opposed to like a lot of people aren't generalist, which is why we like work with you very closely. This is so with these practical sessions, what we're giving you access to right now is usually the type of support that our portfolio companies get. So as Blair just mentioned, normally she would work very closely post-investment with one of our portfolio companies to figure out exactly the type of services, which is also like geographically and regionally specific. Yeah, so very, very fortunate for us to get access to them today. And so, yes, we can create some of those more generalized lists. And if Daniel's willing to spend a little extra time, do more one-on-one.
It really varies by, when you'll go talk you at some point you need to get directors insurance. And so then you go talk to groups about that. And that ranges from like $2,000 to
the exposure, right? Like it's all, and by the way, like I'm sure you have some of those preferred banking relationships too. Like when you're opening accounts, they're like, hey, talk to this company. Like, and like RBC does that, for example, RBCX and, things
And
like
like
that.
even kind of like these internal like tech stack things, what you need, like you can go online, people are going to pay, $20 to $40 a month for like a QuickBooks account, right?
Yes.
Like a payroll provider, there's a range depending on the gamut of the services that you want to roll in with outsourcing finance. There's like base that is just books and records, and it'll be like a couple $100 a month. There is a more fulsome where it might be, a cost of $5,000 a month. But at a $5,000 a month cost, they're doing, a lot more cradle to grave and managing everything. And if you think of, that translating to maybe it's 60,000, but compared to what you might have had to bring in internally, it's not so bad.
Totally.
It's almost always going to be cheaper at the beginning. Yeah.
Great. Thank you. Thanks.
Thank you, Amit. And I'm not seeing any other questions. This is the last call for questions. Just generally, I don't see any more Samuel. If founders are not US origin and they want to register a startup and build it in the US, how does that work? This will be our last question for today.
So, and I can address that. Generally, and this is like very generalized because there's lots of different facts and circumstances. Generally, if you're incorporating or setting up a new company in the US, there will likely be a requirement that just like base bylaws of a company that a certain percentage of the directors of that company do need to be US citizens. A lot of times, if that's not the case, a company may have a parent company that there's like way more complexities associated with this, but I'm just giving a very high level. There might be a parent company that is formed in a different jurisdiction that creates a subsidiary that is wholly owned in the US. There are a lot of tax considerations when that happens, and I'm going to throw something out there called, intercompany transfer pricing agreements that need to be considered if you do that. So it's like very specific to the facts and circumstances of, the residency of who actually is the shareholder of the company that you may want to form in the US.
Perfect. I think that was an excellent, concise answer, Blair. And just to round out, any advice you'd leave our AI founders with? I'll give it first to the radical boardroom there, and then Daniel, if you want to close us up. Any additional?
I don't know, but I feel like I'm on the spot here for some words of wisdom. Maybe that's what I'm going to leave it with.
Okay, perfect. Anything else from the team?
I think focus on what you're good at and don't be afraid to engage experts where needed.
Yeah, and even beyond that, just, talk to your relationships, talk to people who are going through the same thing as you, right?
Talk to your AI founders community, put it in the Ask channel. We are here for you. A lot of these folks are in the community, so if you post things there, they will respond. Daniel, last words of wisdom.
Yes, but all of these things get solved if you figure out your customer and the problem you're solving for them. If you spend 95% of your time there, everything we're talking about here just has a way of sorting itself out.
Amazing. So thank you, everyone. We really appreciate you joining, both from this is our Toronto boardroom team here. So thank you, Katelyn, Eben, Erica, and Blair. And also thank you, Daniel, for joining us today. So just a reminder, you can ask us questions in the chat. Daniel's actually pretty active in there, so you're very fortunate to have his wisdom. And then we will continue to do more practical sessions. Just going to share my screen for 2 moments. A reminder, next week is our last week. So we have extended the application deadline for the Compute Cohort. So if you are interested in $250,000 of credits, I would suggest you apply. If you have any questions about that, this was also supposed to be a Q&A around that. We didn't quite get to it. So if you have any questions, DM me, can shoot you a message. Next week, we are very fortunate to be joined by Max Jatterberg of Isomorphic Labs. Watch the time change. This is on the Luma. It is going to be slightly earlier in the day because this is being run from London. So it is going to be a little bit earlier than expected, but it's still, I think, around 9 a.m. PT, but just double check there. If you're not in the Luma calendar, please do that because that's where you're going to get all your reminders. And then Max is going to be joined by David Barber. David Barber is a Radical Venture Scientific Advisor, but he's also the UCL Center for Artificial Intelligence Director. Going to be a really interesting conversation there. And then we have our last go-to-market session. So we've extended the cohort application for cloud so that you can have a chance to hear from Parisville. And the special guest is going to be Sean from Weights and Biases. So he has a lot around product that he's been building there. So it'll be great to have him chat about that. And I will share the details in the Slack as always. So thank you, everybody. Make sure that you're in the Slack asking your questions. You can DM us. And a big thanks to our Radical team today. All right, take care. Have a safe and wonderful afternoon, everyone.